Good morning and welcome to the Rate Update with Dan Frio. I am Dan Frio. Today we're going to talk about, or just announced, is the initial jobless claims and continued jobless claims. They're coming right into what I expected, and I've been saying for the last 6 months to 12 months. I said, wait till December. Wait till January. These numbers are going to start coming back. And then in the first quarter of next year, we're going to see a little more normal. And then the second quarter, more normal. And then we're going to get back to normal by mid-year. What's that mean for us? What's it mean for the real estate business and mortgage rates? That's why you're here, to find that out. So don't go away. We're going to talk about that and much more next. Okay, so let's get to these great headline numbers. Take it away, Rick Santelli.
Initial jobless claims for the week of December 4th, 184,000, a nice drop. And so far, no revision of last week's 222, and it is a post-COVID low. If we look at continuing claims, 1,992,000. 1,992,000. It is not a post-COVID low. Last week remains that way. This is the week of November 27th, so always a week in arrears to initial claims. And last week, at least at this point, still unrevised. Well, there it goes. It's not revised. 1,954,000. So it's still a bit lower, but these are pretty good numbers. Let's put it in some context. If we go back to March of 2020, continuing claims were 1,715,000. Not so far off. And if you look at all of 2019, as the Wall Street Journal did for us today, the average per week on initial claims was 218,000. So we are definitely getting in the right zone for these numbers. And maybe the most important issue is it's not so much about claims. It's more about employers are certainly reticent to let any employees go, considering we have basically a deficit of workers to put in those slots that remain open and can't find people to fill. This is a huge dynamic, but I would caution, this isn't a dynamic of the United States. It's a dynamic globally. Joe, back to you.
That's interesting. So, yeah, we think sometimes we're just what's in front of our face. So we're seeing this across the globe, Rick. Interesting. Thanks. Let's get to Steve Leisman, who joins us now with more. Was today the All-America thing, Steve? Did I hear that earlier?
Yes, you did, Joe.
Awesome. Awesome.
But we did that in the last hour. We got more coming up at 10 o'clock. You can go online, read all about what the people who are the greatest football players in college believe. No, just I made the joke for you. But look, Rick and I having a mind meld. On what the most important issue is out there. This 184 is a big number. I don't think there's a couple weeks ago you had a bunch of seasonal stuff that was in there that made people a little worried when it went back up, said it was going to come back down. It did. So I don't know if we're seeing a little bit of payback on that. But this is an unbelievably low number, and it's very important. And what it points to is tomorrow, guys, we have a big inflation report. And well, what spooked the Fed? I think the wages and how tight the labor market is spooked the Fed. And you also have coming housing inflation. Take a very quick look, if you could, guys, at the JOLT survey from yesterday. We don't get to talk about that a lot because it happens at 10 o'clock. But look, 11 million. We are not apparently making progress at solving this job openings problem, bringing people back to work. So what that tells me from an economics point of view is we have not yet reached an equilibrium wage level that is required to bring people back to work. So you've got that one issue. We got to get these jobs filled. Once you do that, there may be another process, Joe, which is you bring workers in at this level, at this wage, your managers may want to raise. So this idea of finding the right equilibrium level for wages could go on for a while. I think it's one of the reasons that's moved the Fed to move a little bit faster. That and the idea that you may have coming housing inflation over the next several months working into the CPI. Housing prices have been up, but we haven't seen it in the data yet, so it may be showing up. So those are two reasons to sort of stand up or sit up and put your shoulders back and pay attention to that CPI data tomorrow at 8:30.
Dag. Do you hear what they talk about when they take it to Wall Street and all the other ones? They talk about initial jobless claims. the Jolt Index, what the Fed's doing, CPI numbers. Most people, they don't have a clue what's going on. You guys do because you're watching. So if there's any family, friends, neighbors, relatives, coworkers, anybody, send the videos to it, especially in the real estate business, the mortgage business, or they're looking to buy, build, or refinance their home. It's basically, I try to do this for educational purposes. So that being said, let's get off to what effects is this having on the markets this morning. I can't find my glasses, so I found some old cheaters that my wife uses, so bear with me. These are hers. So let's get on to what's going on in the markets right now. So here's what we got. So we got the weekly jobless claims fall to 184,000, the lowest level in more than 52 years. So there's, as they were saying, there's a disconnect with, it has to be down to the point of wages and employment. But at some point, it's going to have to be, if you're unemployed and you're holding out for a six-figure pay, how much longer can you wait? As employers, what they're trying to do, I'm going to side on the side of employers right now, is the laborers, like Steve Leisman just said. If employees want more money, then managements want more money. So then what do you have to do as a company? You don't want to make less money. Look at the oil companies, look at the banking companies, look at all these companies that are posting record earnings. How do they do that? Well, if they're paying their employees more, how are they going to continue to do that? Well, they're going to have to raise prices. When they raise prices, that's inflationary. So this is going to have to come back to normal levels. We need that to make the everything click. Okay, so that's that. So where are we with rates today? So let's get on to the rates. This is where they started today, so where they ended yesterday, and then I'm going to show you what effects that the jobless claims did for the initial market moves. And then later this afternoon, I'm going to go over FHA loans. If you have an FHA loan, how you can refinance if you're in forbearance or out of forbearance, the easiest way for you to refinance. And many of you might want to look at refinancing just to drop your PMI. Because if you have PMI on your loan, there's probably a great chance if you have an FHA loan, that PMI is on there forever, all 30 years. So you don't want that. So let's go over the rates. The 30-year fixed rate, guys, these are not mine. Let me disclaimer. These are not my rates. These are the national averages. To get my rates, I need you guys to reach out to us. So let's go over this. The 30-year fixed rate is 3.25. No change from yesterday. The 15-year is 2.59, down 1 basis point. What is 1 basis point? Well, that's what it looks like, 0.01. FHA is up 1 basis points at 291. That's the same, pretty much VA rates are basically the same as FHA. Jumbo is 315, no change. In the 5-year arm, as volatile as always, it's up 7 basis points at 355. So why in the world would you look at doing a 5-year arm when you can get a fixed rate at 30 basis points lower? Just a food for thought. So what's the initial information doing for the markets? Well, you can see we're up 8. What does that mean? What does these charts mean? What does all this mumbo jumbo mean? Well, this is what's happening to the price of a mortgage-backed security bond that trades on Wall Street. That bond determines your mortgage rate, basically, or is the biggest component of that. Not the 10-year Treasury. We don't follow that. We don't follow the S&P 500. We follow the mortgage-backed securities market. These give us gauges on what's going on in the stock market and the Treasury markets. But these have not a direct correlation, but if you follow the stock market, if it's down, usually bond prices are up and so forth. There's usually a counter there. So then when you go down to here, here's where the charts are. Okay, so guys, I've been saying, I'm expecting now for us to trade. If you look at this number right here, I'm going to say, I expect this number right here to trade at a 102.4. Let me put that in context. We're up 9. We were just up 8. So I'm not going to go through all my studies and why I'm saying a 102.4, but we should be trading right around this range right through here. And we're pretty much right there. Okay, and we've been trading there for, look at it. Basically, since October 25th, we've had up and downs, but that's where the normal is. So I'm looking for pullbacks and moves based on that chart line right there. So that's, just trust me on this one, guys. Follow me on a daily basis. You'll find out what's going on with mortgage rates. I'll explain as much as I can, but I'm not going to go too deep and lose you. The economic calendar for today, as we know, the Jolt or the initial jobless claims came in and continued jobs claim in. Let's double check those. Continued jobless claims came in at 1.9 million. The consensus was 1.9, and last month was 1.9. So we'll just take that in context. Nice number. I like that number. Initial jobless claims. This is the shocker. Last month was 227,000. Consensus was 215. We came in at 184 for initial. So that means a lot of people, well, the slowdown is coming for people quitting their jobs. Tomorrow, we're going to see the inflation numbers like Steve Leisman said. We're going to look at the CPI. The Fed really doesn't monitor the CPI. They watch more of the PPI and other factors, but this does play a role in what's going on there. What's going on with the intraday chart? Well, let's see that right here. We opened up way up, and then we kind of retreat back, and then we're right in this range here. So I expect us to get up to about here in the next couple days, if not today. What this means is, let me go back in context. This is what's going on with the price of the mortgage-backed security. So the easiest way for me to explain this to you is when the price goes up, and in this case it went up, when the price goes up, then we see mortgage rates come down because there's an inverse relationship there. Okay, so what happens is if the price of a bond goes up, yield on that bond, and in this case it's mortgages, goes down. That's just how all bonds work. So we love paying more for the bond if it's a mortgage because that drives down the yields. If we're an investor, we really don't want that. Okay, so that's that part of the equation. So now let's get on to, we went through the intraday. Well, that's it. Okay, short, simple, and sweet. So I hope you like my videos. If you do, all I ask you to do is give us a phone call. Call us, email us, schedule a meeting. Let me go through these. If you're building a house, reach out to us. I did a bit of video last night on how you guys can negotiate with your builders. Now, I don't want you to lose your house because there is supply-demand issues. But when you go in there on the initial consultation, say, hey, you know what? Instead of giving me a $10,000 credit, why don't you cut it from the price? They might not. It's worth a try. Okay? So if you're in the process right now of getting a mortgage, the mortgage company had to send you what's called a loan estimate. That loan estimate goes over everything, every penny of where that loan, all the money from that loan, where it's going. Send me that loan estimate. I will be your national mortgage advisor. What I'll do is I'll scan your loan estimate. I'll review it. I'll compare it to over 180 lenders in the entire country to make sure you guys locked in at the right rate, the lowest fees, and one most of all, the right program. Because some banks make more money on government loans like FHA and VA than they do normal loans, conventional loans. So be careful that they don't shove you into one of those loans when you could actually fit into conventional financing, because you could save a lot of money there if you do qualify for conventional financing versus FHA. Just food for thought. This is how we look out for you guys when you're looking for a home. So how do you find out more about me and my team? Well, the easiest thing to do is go to therateupdate.com. You can see that up below. I got to remember this because it's inverse. Okay. What you'll do is you'll go over to the phone number. Give us a call, 844-775-5626. Remember that number, because if you call the wrong number, you might get the Loan Depot. And I'm hearing bad things about them from clients that said, Dan, I thought I was working with you, but I end up getting them and it was horrible. The next thing you could do, you can apply now. If you know what you're doing, you know what you qualify for, and you're like, Dan, just help me, you have to apply now button. Otherwise, we would love to schedule a meeting. Schedule a meeting with us. Why? We can go over your financials. We can share our screen. You can share your screen, and we can make sure you're getting the best products at the best price and everything else. So last but not least, please give me a thumbs up. Subscribe down below. Hit the bell every time I post a video. You get an alert. Love to hear from you guys. Place any comment down below. I have a lot of people commenting. I reply to every comment, or I try to. And then if you give me some ideas on what to do on videos, I'd make sure I'll get one of those done for you within the next week or two. God bless, guys. I'll see you later this afternoon going over FHA guidelines and rates. See you then. Bye-bye.